So Canadian net household worth has gone up 22% in the last year. And the Canadian banks are offsetting stress test limit by manipulating the debt servicing ratio. How? Let's find out. What is up YouTube? What is up Canada? Thanks for joining in. As you know, the purpose of this channel is to educate my audience about the real estate market in Canada with particular focus in Toronto and GTA, as well as some of the macroeconomic factors that has an impact on the real estate market. In this video, I'm going to cover how these commercial banks are manipulating the debt servicing ratio to offset the stress test limit, as well as some of the data that we got from Stats Canada that shows you the Canadian net household worth has gone up 22% in the last year. So before further ado, let's dive into it. So we received the Stats Canada data last week, and that shows you the Canadian net household worth has gone to $13.7 trillion in Q1, which is 6% rise from previous quarter and 21% rise from previous year. That equates to over $700 billion in total gains for Canadian in the last year alone. Now, of course, you know, this is a net household worth, but the majority portion of that worth has dependency on real estate. Now, real estate has contributed, represented 50%, over 50% of the entire household worth. Now, if you look at this graph, you can see, you know, we have data that goes back all the way to 1990s. So over the period of like 30 years, you can see the Canadian net household worth was fluctuating between, you know, 5 to 10% most of the time, and at occasions, you know, it went up to 12%, as well as it went down to below zero as well. But look at from 2020 onwards, what happened. It has been on a hockey stick and rising vertically almost, which is completely an anomaly and unusual, and we haven't seen this before. From a real estate ownership perspective, of course, it's a very good sign for the owners because their wealth is being, you know, generated. But from an economy perspective, it's not a good sign, because when you look at the economy, if only the one sector in the economy is producing, it's growing, and the other sectors are struggling, then it's not a balanced economy. Plus, real estate segment is not a productive asset. We call it non-producing asset because it doesn't generate money that goes into the circulation, right? So all the money and the wealth is being concentrated, accumulated in one segment, and it's not being flown into the economy, which means it's not producing anything good for the economy. So in the long run, of course, it's not a good sign. It has to be fixed. Now, how it's going to be fixed, we have to see that, you know, how other sectors start, you know, performing in the coming future, especially when the lockdown is over. Hopefully we will see the borders open and immigration start coming in, and ultimately other sectors like retail and finance and restaurants will start producing some results in the economy. This graph actually shows you the breakdown between the net worth and the real estate as well, and you can see, you know, almost 50% of the entire net worth is dependent upon real estate, and it's pretty much similar pattern from 1990 onwards. The other thing I want to tell you about, guys, is the stress test limit. So we have seen the stress test has been implemented, you know, from June 1st onwards across Canada. But these big six banks, you know, they are manipulating the debt servicing ratio to offset the stress test. Now, if you don't understand how what is the debt servicing ratio, I can tell you quickly. The way the bank assess you and decide, you know, how much money they can lend you is based upon the debt servicing ratio. There are two types: GDS and TDS. GDS is the gross debt servicing ratio, and TDS is the total debt servicing ratio. Basically what it is, they calculate your total expenses, your liabilities, your current assets, your current credit, and like car loans and stuff. They add them all together and divide by total income. That determines the debt servicing ratio for your profile. Now, the industry standard is the GDS has to be 39 and below, and TDS has to be 44 and below. So as long as your GDS and TDS is below this benchmark, you're good to go. You can get the loan and you can purchase your property. What happens when your GDS and TDS is above that benchmark? Now, in that case, these banks have an exception criteria where they can see your total income and they can see your credit history. If these two things are strong, then they will let you they will lend you the money even though your GDS ratio is above the benchmark standard. Now, that's what banks are doing right now. So we saw that the stress test is actually reducing your buying power by reducing the amount of loan that you can get. But in order to offset that, the banks are basically allow you to slip up your GDS TDS ratio above the benchmark, and then get more loan, more credit, even though your requirement to meet stress test is not being fulfilled. So the reason I'm telling you guys is these banks are actually making it easy for you to take credit as long as you have good income and good credit history and you are putting 20% down. It's very easy to get the mortgage and buy the property. So these banks are basically making it very easy to acquire assets, and that's why I've been telling you guys that these banks are the number one reason behind this crazy market. Now, I feel very sorry for the first-time home buyers because they were the one being further marginalized because of this. But guys, this is how the financial system works, and this is not something specific to Canada. It is across the board. All the major financial markets in the world works like this. And the purpose of this channel from me is to educate you so that you can make educated decision about your financial being and make wiser decision, because I don't want to be poor tomorrow. You don't want to be poor tomorrow. So invest wisely, and real estate is one of those proven assets which will give you return in the long run. Do not treat this as stock market, because in the short term you will lose, perhaps you will lose money, but in the long run, at least 8 to 10 years guaranteed return if you stick to it. That's all from me this week, and I will see you in my next video. Take care.